Japan has launched a stimulus package that could add almost 0.5% to GDP growth. But bond investors aren't keen on the extra borrowing to pay for it, driving up yields to near record highs. That's coming up in 5 Things in 5 Minutes on Monday, November the 24th. And then in our deep dive interview, ANZ's head of FX research, Mahjabeen Zaman, takes a closer look at stablecoins after the passing of the Genius Act.
This could be actually a way to dollarize without holding US assets outright. The big question is stablecoins going to replace or undermine the dollar? We actually think that the rise of stablecoins could actually reinforce its global role.
But first, in 5 and 5 with ANZ, Japan's new Prime Minister, Sanae Takeuchi, has launched a major new stimulus package worth nearly $135 billion US. Here's ANZ's senior international economist, Tom Kenny, with the details.
The spending part of the stimulus package tackles three main areas. Firstly, 11.7 trillion yen is aimed at giving price relief to households who have faced significant cost of living pressures in recent times. There will be subsidies for utility bills and cash handouts for children. Secondly, 7.2 trillion yen will be invested in priority sectors like energy transition and decarbonisation, digital infrastructure, AI and semiconductors. Finally, 1.7 trillion yen will be investing in Japanese defence and diplomatic capabilities.
Over the weekend, the S&P 500 closed up 0.9% and the Nasdaq ended up 1.1%. The yield on the US 10-year Treasury fell 4.1 basis points to 4.063%. West Texas oil futures fell 2% to $57.81 US a barrel. Gold rose 0.5% to $4,116 US an ounce. The US dollar index was flat, but the Aussie dollar rose 0.3% to 64.56 US cents, and the Kiwi was up 0.5% at 56.14 US cents. Number 2. Tom sees Japan's fiscal stimulus helping GDP growth, but without much extra inflation.
We estimate the package will add around 0.3 to 0.4 percentage points to annual GDP growth and have minimal inflation implications. There are limited implications for monetary policy from this stimulus package. The Bank of Japan at the moment is a little bit cautious about elevated trade uncertainty and has lost confidence, at least in the short term, of achieving its 2% inflation target. It wants a bit more time to see a strengthening nexus between wages and inflation before raising rates again. The fiscal stimulus was pretty much in line with expectations and there was a muted bond market reaction. Longer dated yields have been trending higher in Japan and at the highest level we've seen in decades. Tighter monetary policy, rising inflation and concerns over a substantive fiscal debt are driving yields higher.
Number 3. ANZ's head of FX research, Mahjabeen Zaman, says the Bank of Japan, or the BOJ, is likely to remain cautious about hiking rates despite the stimulus, which is likely to keep downward pressure on the yen versus the US dollar.
We do think that the Bank of Japan will likely remain cautious on hiking. While we do have 2 more rate hikes penciled in for next year, again, a lot depends on how the CPI continues to move. We have seen a little bit of stickiness in services CPI, which actually has shown some cooling in recent months. And at the same time, board members have also suggested caution over the sustainability of inflation as one of the reasons for holding back for rate hikes. Furthermore, we have seen growth also has softened in recent months, so based on the Q3 GDP numbers. This is not helping the yen and, expectations of hiking are pretty low.
Number 4. The fiscal stimulus is being noticed, though, by Japanese government bond markets, or JGBs, as ANZ's Group Chief Economist Richard Yetzinger notes.
We have had this worrying rise in long-term bond yields in Japan. The 10-year bond yield now is 3.4%. That's right, 3.4. It's not that long ago. It seemed to be a part of the kind of zero long-term bond yield story, and it is no longer. I'm going to be interested to see how markets respond to this announcement of extra stimulus, because at some point, as we've seen in the UK, when debt levels get higher, extra stimulus is not welcomed by the bond market as a potential growth story. In fact, the bond market starts to worry about it because of an excess debt story. A Japanese 10-year bond yields at 3.4% starting to signal that. I think they're certainly flashing amber.
Number 5. Richard says debate about AI stock valuations will also be closely watched in the week ahead, given global investors are more exposed to the valuations of just a few companies, and that US stocks now make up nearly 3/4 of the Morgan Stanley Capital Index, the MSCI.
The credit market has absorbed $200 billion of AI-related issuance over the course of this year. I think there's a lot of potential transmission mechanisms there. If we get a washout in the US AI companies, I think it will be difficult for other markets not to be caught up in that.
Richard Yetzinger there. Now, in a deep dive interview, ANZ's head of FX research, Mahjabeen Zaman, has taken a closer look at the future of stablecoins after the launch of the Genius Act in the United States this year, which requires each coin to be backed one for one by liquid and secure assets, but it can't pay interest.
The passing of the Genius Act will likely result in significant growth in issuance because being backed by liquid and secure assets such as treasuries really does enhance the safety and reliability across the stablecoin space.
Why would anyone want to use a stablecoin if it's backed one-to-one with, let's say, treasuries or other liquid high-quality assets? Why not just invest in those assets to start with?
Look, I think stablecoins enable individuals to obtain dollar-backed assets without relying on traditional banks or the SWIFT payment system, particularly in markets where currencies are a little bit unstable or insufficiently regulated or have restrictive capital controls. This could be actually a way to dollarize without holding US assets outright. So, broadly, I think the big question is stablecoins going to replace the dollar or undermine the dollar? We actually think that the rise of stablecoins could actually reinforce its global role by holding treasury bills and offering offshore investors access to USDs via stablecoins. I think stablecoins have actually the potential to increase dollar penetration, which kind of challenges the ongoing de-dollarization narrative.
Could you see a time when stablecoins potentially replace traditional currencies?
Look, I think it does come with a lot of benefits. It also provides max market access as well to dollars. But at the same time, it is not a risk-free asset. So while it is designed to maintain a stable value relative to fiat currencies, stablecoins are digital representations of claims on underlying assets such as treasuries or cash equivalents. And also they're issued by private entities. They don't pay interest like cash does. And also they're not backed like fiat currencies are by sovereign guarantees. So again, it's hard to align just a one-on-one sort of comparison between stablecoins and cash.
Now, can you talk about this idea of singleness and why that's important?
Look, we don't think stablecoins will take market share from established forms of money because they do not possess the property of singleness. Now, singleness basically refers to the value or the form of money that actually maintains a one-on-one value with central bank money. It applies to cash, bank deposits. And, there are several factors that contribute to singleness. And that is, having deposit insurance, which is provided up to a certain amount by the regulator. There is also a lender of last resort facility provided by central bank where deposits are held. Of course, there's par convertibility, which means a one-on-one exchange at face value. And then obviously interbank transactions are settled using central bank funds through established payment system. Now, stablecoins don't meet all of these requirements. And as a result, we speak about the fact that stablecoins then lack that singleness.
And could stablecoins be more popular with businesses than others and effectively crowd out the credit creation process by banks and also potentially make it easier for the government to raise funds, given these stablecoins have to be backed by treasuries and other liquid government-backed securities?
Look, I think there was a study done which showed that stablecoins might actually increase funding available for governments, and this could be at the cost of crowding out private sector lending. Now, it's interesting because the flows of funds from bank deposits to stablecoins will effectively also then increase treasury demand, but also then reduce the supply of loans in the economy. And as a result, if you see the stablecoin market growing, the corresponding growth that could represent a shift from bank deposits to stablecoins would then see a decrease in bank assets and bank lending. So yeah, there could be a reduction in bank loans to the economy. But again, we are still in very, very early stages. The size of the market is only just building up. When we think about cryptocurrencies or the growth of stablecoins, we have not seen a noticeable decrease in the use of traditional money, whether we look at cash or bank deposits, including cash held in money market mutual funds. And at the same time, stablecoins remain too risky to compete with bank deposits, over which their main advantage is the speed of set processes and their access to decentralized finance platforms. So again, we think stablecoins would likely remain a niche form of money.
Mahjabeen Zaman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, November the 24th. Catch you tomorrow with detail from Singapore's September quarter inflation results, where the annual rate is expected to rise to 1.1% from 0.7%. That's thanks to higher car certificate of entitlement costs. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.